Thank you for coming and enjoying my crazy show. My name is Bill Quick. I'm an attorney at Polsinelli here in Kansas City. I'm our law firm's Corporate Transparency Act chair. I became aware of this act um, out of shock and awe in January of 2021. I'm a corporate attorney and I'm kind of a business entity wonk. Do a lot of work helping manage clients' portfolio of companies in doing financing and refinancing and corporate governance and things of that nature. So I'd been aware of the existence of this concept of a corporate transparency legislation that had been, you know, uh, consistently every year to 2 years, charged up the hill toward Congress, tried to get it passed. The lobbying contingency, repelled it, and it kind of went back, licked its wounds, and you didn't hear about it for a year or 2 years. And I remember sitting in or actually, so this is, during COVID, so I was on a Zoom like this, and I was helping a client in Missouri who wanted to set up an entity, but didn't, wanted to minimize the amount of public disclosure of his identity. So we talked about the different options. Said, well, the Missouri Limited Liability Company, you form the entity, you have the name of the entity, your registered agent, your resident office location, and then you never file another thing for the entire time that entity is around. And he's like, great, that sounds good. Let's do that. And just as we were getting ready to get off the call, I distinctly remember this. I'm like, before we get off this call, I would be remiss if I didn't tell you that there's this thing called a Corporate Transparency Act that's been, getting kicked around Congress for the last 20 years. I don't think it's ever going to get adopted, but if it does, it would impact this because you'd have to disclose information. It's like, okay, well, thanks for sharing. I'm like, okay, just of abundance of caution. And literally, a couple hours later in the afternoon of that day, I had this email come across my, Outlook, and it's like, hey, sign up for a seminar about the new Corporate Transparency Act. And I was like, what? What the heck? That actually happened? So I started digging into it. I'm like, holy cow, this actually got adopted. And it's got an interesting backstory. I won't belabor it, but the Corporate Transparency Act is about 7 pages buried in the middle of the National Defense Spending Act back in 2020, which is about a 1,400 page, omnibus piece of legislation. And it was so that National Defense Spending Act was the only piece of legislation that Donald Trump vetoed during his term as president of the United States. So he vetoed this act. And if you'll remember back in 2020, we had a very conservative House. We had a very conservative Senate. They controlled everything. And those two bodies, by a 2/3 vote of each, overrode his veto and put this into law. So a lot of people think, oh, well, this is some, liberal agenda, and the snowflake crowd has pushed this through, and it's going to get overturned later when the conservatives get back in control. I don't think that's the case, and this was not a liberal agenda. Well, I mean, it was a liberal agenda item, but it was adopted and approved by two very conservative bodies of Congress originally. And there's a lot of posturing, and there's a lot of showmanship of people presenting bills to unseat the Corporate Transparency Act or to make changes in the Corporate Transparency Act. And I just don't see that happening. And it's certainly not going to happen before the filing deadlines accrue that we're talking about here today. So this is here. It's here to stay, at least for the immediate term. It's here. You are going to have to report if you have an entity that's a reporting company, and we'll talk about that. So I think this is a timely issue. I would guess that maybe most of the people on this Zoom are at least aware of the Corporate Transparency Act, and that's why they're here. There does still remain a material, although maybe less than a majority of the business community that still is not aware of the Corporate Transparency Act or doesn't think it applies to them. But the days of that, blissful ignorance are coming to an end. And we are reaching quarter 3 of 2024, all entities that were formed prior to 2024 that were in existence on January 1st will have to file, if they are within the definition of a reporting company, by January 1st of next year. If you've created an entity or registered a non-US entity to do business in the US, anytime on or after January 1st of this year, you have a filing obligation as well. And that filing obligation is within 90 days of the date that the entity is created or registered. And then starting January 1st of 2025, that's going to move from 90 days to 30 days. And that 30 days is going to carry forward in perpetuity. So there are some very short time frames to comply with the act that are going to get shorter. So without further ado, let me start in. So make sure I'm sharing my screen. So is everybody able to see the PowerPoint slides now? Okay.
Yeah, appears to be so.
Okay, so there's a number of things we're going to talk about. We've already talked about kind of the Corporate Transparency Act universe. We'll talk a little bit more about that. We'll talk about reporting requirements. What's a reporting company? What do you have to disclose about a reporting company? Who are beneficial owners? Who are company applicants? We'll talk about personal identifying information. That's the part that everybody enjoys the most. You've got your photo and your passport or driver's license is going to be in a federal government database. That always brings joy to people. Obviously, there's going to be a lot of sarcasm and facetious comments during this program, and I'll apologize for it, but it's going to happen because that's just the way it is. We're going to talk about reporting versus exempt companies. We're going to talk about the deadlines for filing, which I've already mentioned a couple of those. We'll talk a bit about the Alabama court case that was handed down by the Federal District Court in the Northern District of Alabama, March 1st of this year, that said, hey, Corporate Transparency Act's unconstitutional. Asterisk, there's a lot more to it than that, but that's usually where people stop listening is, oh, it's unconstitutional, I don't have to worry about this. That's not the case for probably anybody on this call. Vast majority of the country, that is not true. We're going to talk about penalties and enforcement. We'll talk about who has access to this information that once it gets in the database. And we may talk a little bit about some other state transparency initiatives, but I don't think that's really going to impact the people on this Zoom, and we're probably not going to have time for that. I will say questions and answers. If you have questions, go ahead and shoot those at me as we go along. As we're talking about things, you don't have to wait till the end. I'm happy to answer any questions. I'm going to impanel Jeff to be the moderator. If he sees any questions come up, Jeff, just jump in and say, hey, Bill, there's a question, and then let me know, and we'll answer it.
10-4.
Okay. So, why do we have the Corporate Transparency Act? The Corporate Transparency Act is intended to combat the use of shell companies and the commission of illicit activity and corrupt practices, as well as to protect national security. So it protects against money laundering, financial and tax fraud, terrorist financing, ferreting out, sanctioned individuals like Russian oligarchs who we're not supposed to be dealing with, but may have, snuck into the U.S. and put some money in a U.S. entity. Those are kind of the reasons for the act. If you've heard about the Panama Papers or the Paradise Papers, or the Pandora Papers, there's also, like, way back, there's the Liechtenstein Papers. And there's a Netflix series that came out last year called Gunter's Millions. And it's about this German Shepherd in Italy that was the beneficiary of like hundreds of millions of dollars of trust money. Spoiler alert, if you haven't seen it, it's interesting. But it all ties into the Liechtenstein Papers and was the impetus for kind of the first foray in trying to unseat, the identity of people behind, shell companies and methods to evade taxes rather than avoid taxes. So the Corporate Transparencies Act requirement, it requires certain business entities. Everything is tied to an entity. So if you have an entity that's created or registered to do business in the U.S. through a filing with the Secretary of State's office or a comparable office in other states. So in New York would be like the Department of State, Arizona would be the Arizona Corporation Commission. Just because you're not called a Secretary of State doesn't matter. If you have the equivalent authority of a Secretary of State with regard to creating business entities, then you're in the mix. If you have an entity that is created by a filing with a Secretary of State's office, then you're potentially in the soup. And we'll talk about some exemptions that might pull you back out of the soup. But if that describes you, then you're in the soup. So that'd be corporations, limited liability companies, limited partnerships, certain statutory trusts, if they're created through a filing with the Secretary of State. You've got limited liability partnerships, limited liability, limited partnerships. All of those could be drawn in if they're created through a filing with the Secretary of State. So to some degree, this is all going to be a state by state determination as to, well, what do you have to do to create this? In some states, I believe Missouri is one of them, you have to do a filing with the Secretary of State to create like a limited liability partnership. Other states you don't. And this I'm sure everyone on this call is going to enjoy it. This has been a hotbed topic of debate in the legal community because a lot of law firms around the country have been set up as LLPs, and they don't want to file just like everyone else. So there's people arguing why they have to, and there's people arguing why they don't have to. But that there is some debate about that. Corporations, limited liability companies, limited partnerships are almost always going to be created through a filing with the Secretary of State. So if you have any of those business entity types, this act is I don't know if it's for you, but you are going to be subject to it. So the CTA's requirements is that certain business entities, and this can be a private company. If you're a public company, you're going to be exempt. But if you're a private company, including a nonprofit entity, you could be subject to these requirements. And the requirement is you report direct and indirect beneficial ownership information about the entity. Beneficial ownership is only disclosed for human beings. So a lot of things we're going to talk about, it may seem like there's a business entity that could be in the mix, which there may be, but you never are reporting a business entity as a beneficial owner. It's always going to go to ultimate human ownership, which could be, immediate. If you're a human being, you have a member interest in LLC, it's immediate. If you have holding companies and you've got 1,000 holding companies between you and an asset, like a piece of real property, you look through all those 1,000 entities until you get to the very tippity top, and you look at those people, and if they meet the criteria, then they have to be disclosed for that subsidiary that's 1,000 entities down. And spoiler alert, you're probably going to have to be disclosed for the intervening 1,000 entities as well. So each business entity has to make its own independent determination of whether the Corporate Transparency Act applies to them or not. If it applies to them, you have to look and see if there's an exemption that you fit within. If you are exempt, then that pulls you back out of the definition of reporting company. You don't have to report. But if there's not an exemption, then you are going to have to file a report with FinCEN. We'll talk about what that looks like and when you have to do that and what gets disclosed. So all of this is administered by the Financial Crimes Enforcement Network of the U.S. Department of Treasury. It's known as FinCEN, capital F, small I, small n, capital C, capital E, capital N. I had no idea what FinCEN was before this act came out. Now I know a lot about FinCEN. So FinCEN is kind of like a sibling entity with the IRS and other departments within the U.S. Treasury. And I'll talk a little bit about the IRS again as we get further into this, because it's going to amplify why this is important to you on this call. So when FinCEN put out their beneficial ownership information reporting rules, which was in September 30th of 2022, they made some projections, as all government agencies are required to, as to what's going to be the impact of this this act. And at that time, they estimated that there were going to be 32 million business entities as of January 1st, 2024, that we're affirmatively going to have to report under this act. They also estimated that there are going to be 5 million new business entities formed each year going forward in perpetuity that are also going to have to file for this. So just in year one, 2024, where we're at now, that's 37 million business entities. And I just say that because every single business owner's reaction when they hear about this is, that can't possibly be true. That's not a real act. The lobbyists never would have let that happen. One, wrong. Two, well, even if it is true, that's for the big boys out there. I've got a small business. I've got an SBA, whatever they want to say. I just have one employee. It's not going to apply to me. Wrong again. That's exactly why this applies to you, because you're a small business, and that's where bad actors have used and abused the entity formation system to their advantage, is through these small businesses that fly under the radar. And there's a whole litany of other knee-jerk responses of why this couldn't possibly be true, why that doesn't impact them, why there'll be a cold day in hell before they comply with this. The sovereign citizens come out and say, well, I don't have a driver's license or a passport, and I'm not going to get one, and they can't make me get, all of the excuses come out. So we're talking about 37 million business entities, which I believe equates to about 90 to 95% of the business entities in the US. So only a very small fraction of the business entities are going to be able to fit within an exemption. Everyone thinks they are exempt. Almost no one is exempt. And we'll talk about that as we get a little further into this. So I think it's important to understand who can access, and I apologize, but there's going to be a bajillion acronyms that are going to get thrown at you. So just bear with me. The system that has been set up to take in this information by FinCEN is called the Beneficial Ownership Secure System, the BOSS system, BOSS. I keep saying I can't believe they haven't, reached out to Bruce Springsteen to get his commercial sponsorship or endorsement on this, but they haven't. Bad on them. So it's called the BOSS system. The information that gets reported into the BOSS system is known as the Beneficial Ownership Information Report, a BOIR report. So that's what gets reported into the system. So the information that can be taken back out of the system is known as Beneficial Ownership Information Transfer, I believe, BOIT. I don't think you need to worry about that, because that's only going to impact government agencies and financial institutions, and you just don't need to worry about that part of the house. That's the other side of the house. So once you have the information reported into the system, the information for the human beings is known as personal identifying information, or PII. Once you have that information in the system, only certain prescribed persons, parties, juridical persons can take information out of the system. And that's federal agencies, federal, state, and local law enforcement. Law enforcement has to have a court order to access information. There are prescribed reasons that you can have for wanting the information. You can't just willy-nilly ask for the information. So your local sheriff can't go and pull information on the boyfriend or girlfriend of their former spouse. It has to be a legitimate law enforcement reason. It has to be through a court order. The other part, and if it's a non-US governmental law enforcement body, UK, France, what have you, may be able to access it, but they have to do it under certain treaties with that foreign government and or with the approval of FinCEN and the U.S. Department of Treasury. So it's going to be pretty limited in scope for non-U.S. parties to be able to access information. The other accessing party is any U.S. financial institution with the consent of their customer. So if you have a business bank account I would expect in the next probably 18 months, you're probably going to get some notice from your lender, person who has your business checking account, what have you, that's going to say, hey, new law, you need to give me access to your information in the BOSS system, or bad things happen. We close your account. You can't get a new extension on your line of credit. You can't take out a new loan. There's going to be some kind of hammer to this, and banks and credit unions and other financial institutions are I believe, going to be effectively deputized by FinCEN to kind of make sure that people are filing the things that they need to file, and or alerting FinCEN to the fact that people haven't filed when they should have. So you're like, well, how is FinCEN even going to know, that I didn't file? Well, they're going to figure it out. FinCEN, the IRS, other government agencies, the IRS in particular, last summer put out a statement. They said, hey, we're taking a new approach to our jobs. One, we're going to use data analytics to help make our job more efficient and streamlined, and to better identify law violators and people that haven't paid taxes that should have, or people that filed fraudulent tax returns. We're going to use data analytics to help inform our enforcement. And they've started to do that. And, there was an announcement, I think it was in May or June of this year, where the IRS is like, hey, we've collected $1 billion of past due taxes from high net worth individuals and people with complex tax structures. And, hold your hat. This is just the beginning. So I will, with almost certainty, guarantee that once the IRS is able to access the BOSS database, everything they do, the second step in their process is going to be, okay, well, let's see what's filed for this taxpayer, this entity in the BOSS system. I just think that's going to happen. So there's going to be all kinds of metrics, data analytics, et cetera, within the government that is going to inform their understanding of who is compliant, who's not compliant, who's falsely complied with the act. So thinking that this is, just another, government initiative that's never going to materialize into anything, I would dissuade you from that belief. So, as I said, the people can access it are federal agencies, federal law enforcement, state, local, tribal law enforcement with a court order, financial institutions with the consent of their customer. So then the question is, well, what's Billy keeps saying beneficial owner. What the heck is that? So a beneficial owner is a defined term within the Corporate Transparency Act. I want you to cast aside any other notion that you may have of what beneficial owner means. Doesn't matter. It only matters how it's defined in the Corporate Transparency Act as interpreted by FinCEN. And what the Corporate Transparency Act says is there are two ways you can be a beneficial owner. One way is if you have 25% or more economic ownership in a business entity. There's going to be a little asterisk because nothing here is as simple as it seems. There's a lot of rabbit holes here. I should just have, Jefferson airplane, White Rabbit playing in the background during the whole thing, because it's just riddled with rabbit holes. The other way you can be a beneficial owner is if you have substantial control. So the little asterisks, substantial control is also a defined term of the business. It's a little ironic because it's a misnomer. There's no owner, a beneficial owner under the substantial control prong does not have to have any ownership at all, but they're still called a beneficial owner. So those are the people that get disclosed as beneficial owners. There's also a group of people, and this only applies for business entities that are formed on or after January 1st, 2024. If you were before 2024, Jeff and I were joking about Nate Bargatze and his comedy spiel about, well, I'm from the 1900s. If you're prior to January 1st, 2024, you get a free pass on this. You don't have to do the company applicant. But any entities that are formed on or after January 1st of this year have to also disclose what's known as a company applicant or company applicants. It can be either one or at most two people. So the company applicants are the people who physically submit the creation filing or the registration filing for a business entity with the Secretary of State's office. So if you walk on down to the Missouri Secretary of State's office, in downtown Kansas City, Mo, and you hand them the paper to form an entity, then you just hooray, you're a company applicant. If you're sitting in your office and you hit submit on an electronic filing to file it with the Secretary of State, hooray, you're a company applicant. You have to be disclosed. There also could be, if the person who submits that filing isn't the person that directed that entity be created, then that second person also as a company applicant would have to be disclosed. So for example, if you guys hire me, aside, please hire me, I'm happy to help you with Corporate Transparency Act. If you hire me and you're like, hey, I want you to form an entity for me, Bill. Okay, great. So then I've dutifully turn around and have one of my associates or my paralegals do this for me. And then they dutifully turn around and hire a service provider like CT or CSC to actually physically transmit that to the Secretary of State's office. There's going to be a human being sitting in a chair at CT or CSC Corporation who is now a company applicant on your BOIR filing. And they know that, and they'll give you what's known as a FinCEN identifier number, so you can disclose that. But they're going to be on that. If it's my paralegal who actually hit submit, or if it's me and I actually hit submit, then their or my personal information is going to be disclosed to the company applicant. There's a lot of ambiguity as to who that second person is. That could be me as the law firm partner involved. It could be my paralegal. It could be the person at the client that says, hey, I want to form this. There's a lot of ambiguity about who that second person is. There's no ambiguity about who the first person is. So my rule of thumb on that is, hey, if you have your name as organizer or incorporator on the formation documents, just use that person as the second company applicant. It's going to be hard for anybody to argue that that person didn't direct or have a substantial influence over the formation of that entity. Just use that out of convenience. So beneficial owners, company applicants, asterisk only for entities formed on or after January 1st of this year, are the human beings that are going to have their information disclosed into the BOSS system. So what's this 25% ownership? Well, that seems very simple. I've got a company, I've got, myself and my spouse and my two kids, and we each own a fourth. So we each have 25%, no big whoop. All four of us have to be disclosed. Well, it gets a little more complicated, and that works great in the S Corp situation because there's only one class of ownership. Everybody has the same rights. But if you have a corporation that has multiple classes of ownership, or you have a limited liability company where different members have different economic rights, they're not all treated, equally, dollars in equals percentage, and that's how the distributions are going out. If there's any complexity there, then you have to start doing an analysis. And if you have multiple classes of securities, or if you have multiple tranches of economic rights within an entity, then you have to look at each one of those classes or tranches and figure out who has 25% or more of that grouping. And each of those people have to be disclosed as a beneficial owner under the ownership prong of the definition of beneficial ownership. So this can get really complicated really fast if you have, a more complicated partnership tax structure, like in a limited liability company or a limited partnership. And, one of the things that drives people crazy, and they hate it, but, it is what it is. If you have a carried interest or a profits interest or a promote, all those terms are kind of used for the same concept, which is I'm getting some percentage of the profits of this entity distributed to me that aren't in proportion to the money I've put in. There's going to be a group of members or partners who all, if you put in 10% of the money, you get 10% back out. that's pretty simple. But if you have a situation where, say, people put money in get their money back first, or maybe certain people get their money back first and then other people get their money back second, and then there's a third stage where you have distributions by percentages and the percentages aren't tied to capital in. All of those things you have to factor into determining who has 25% of each of those different groupings of economic rights. And if you have someone that has a carried interest or a promote and they're just like, great, we're gonna compensate you for how profitable this thing is. We want our money back first. Maybe we want a return on our money first, and then after that, we'll give you 10%, 5%, 30% of whatever profits come out after that. And you're like, great. That person, if they have 25% or more of that group of promote, they're also going to be a beneficial owner. And I've seen this come up where that person may have a less than 1% of the distributions in carried interest, but they have more than 25% of the carried interest, so they have to be disclosed as a beneficial owner. And this is where it starts to get wonky and complicated and difficult on a practical level to have these discussions for me with my client, and then for my client with their business partners to explain to them how they have to be disclosed for this. So that's the ownership side of the house for the definition of beneficial ownership. There's also a control side of the house. So there's a term called substantial control. And FinCEN has given some direct guidance on this, but as with everything else, there's some indirect guidance where it's just like, well, what does that mean? I don't even know. Well, I know, but most people don't know because they haven't burrowed into this and lived it for so long. So certain people are, just because of the title they hold, going to have substantial control. And that's the president, the vice president, anyone who has chief in front of their name. So if you have a CEO or CFO or COO, all those people are going to have to be disclosed because they have that title. If you have an in-house general counsel, so an in-house attorney, that person is going to have substantial control regardless of what their actual control is. FinCEN has just said, if you have that role, you are going to be disclosed. So beyond that, what you have to look for is whether people have the ability to substantially influence major decisions associated with the business entity and or its operations. So that would mean if you have the ability to appoint or remove anyone with substantial control, you have substantial control. If you are on a board of directors or board of members or some kind of governing body that has the ability to make major decisions or on behalf of the entity, you are going to have substantial control. If you have a bunch of equally situated individuals, you've got 10 members of a limited liability company, they all have 10%. If there's no one person or group of persons that has a different control right, then everyone in that group is going to be considered to have substantial control. You can't just by having a multitude of people with equal disparate rights, you can't avoid having to disclose substantial control. So FinCEN said everybody in that instance. You can have negative substantial control. So if you have a veto right over certain major decisions, like dissolving the entity, merging the entity with another entity, if you have the ability to stop that from happening, even if you have a de minimis ownership, you're a 1% member, but taking those actions requires all of the members to agree, then you will have substantial control. If you are a corporation, if you're a senior officer, or you're on the board of directors, you're going to have substantial control. If you're like on the executive committee, or you have some other committee role, you're going to have substantial control. If you're a manager of a manager-managed LLC, or any member of a member-managed LLC, you will have substantial control because all of the members of a member-managed LLC have apparent authority to act on behalf of that LLC. If you're a limited partnership, the general partner of that entity is going to have substantial control. If you're a statutory trust if you're the trustee of that trust, you will have substantial control. You have to be disclosed. So as you can imagine, getting into the specifics of this can be very daunting and frustrating. So I will say, there are other situations where you may maybe have managed service organization or a PEO, a professional employer organization. If you have a third party that through contractual rights does major things on behalf of your business entity, you're just like, well, I don't want to deal with this. I'm going to give all the back office stuff to this other entity and they're going to handle it for me. If you have that situation, then that third party that is not even an owner or has a title with your company, but because they control such a significant part of your operations, they could be deemed to have substantial control of your entity. And you're going to have to disclose individual human beings from that third party on your beneficial ownership disclosure. So this gets really complicated really fast. I've had a lot of discussions recently with our franchise group. Franchisors may be, having to show up on their franchisees' BOIR filings because of the nature of their relationship through their franchise agreements. Very far reaching. So, okay. There are a couple exceptions to the beneficial owner disclosure obligations. So if you have a minor, not like a coal miner, but a young child, which asterisk, you're going to have to look at the state law because each state has its own definition of when someone reaches majority. It might be 18, it might be 16, it might be 14. You have to look at that state law to determine who's a minor and who's not. If you have a minor that has to be disclosed as a beneficial owner of a company because of their ownership or control, you don't disclose that minor. You have to disclose the guardian or parent of that minor in place of the child. So that's one exemption. Once that child reaches the age of majority, you have 30 days from that event to file an amendment that shows the change to that child's name from the guardian's name. If you are a nominee, intermediary, custodian, or agent of a beneficial owner, you don't have to be disclosed as a beneficial owner. So, for example, if you've got Bill Quick hired to help you with the CTA, you don't have to disclose me as a beneficial owner. I've got, this agency role that I'm serving. I'm not really involved with ownership. If you are a creditor of an entity, you generally are not going to have to be disclosed as long as you have kind of customary terms in your lending agreements, which may include, pledge of the entity ownership or other rights. Unless and until you have exercised those rights so that you actually affirmatively take control of the ownership or control of the entity, then you're not going to have to be disclosed. But if it transitions from the creditor relationship to you actually, having your hand in the mix, then that's going to change. If you are an employee of an entity and the only reason you would be disclosed is related to your employment terms and circumstances, you do not have to be disclosed. But if you're a senior officer and you fit within that employee exemption, you still have to be disclosed because you have substantial control as a senior officer, regardless of the other factors. If you have an ownership and an interest and the owner passes away, that owner will continue to be the beneficial owner, although you probably have to disclose the, executor or executrix or the trustee of the trust, because they were going to step in and be able to have substantial control of that ownership. But you would continue to have that deceased person listed until their estate has been, probated. And once that is done, you have 30 days from when that occurs to include the information about the beneficiaries that succeeded to that ownership interest. Do we have any questions so far? I feel like I've been throwing a lot at you at high rate. If anybody has any questions, I'm happy to field them, but I'm also happy to just keep plugging through this to make sure that I can get you, the benefit of as much information as I can. So I'm going to keep going, but Jeff can jump in if there are any questions.
Yeah, we haven't had any questions in the chat thus far, but I'll keep you in the loop.
Okay. So let me talk about personal identifying information, PII, one of our acronyms. So the personal information that gets filed for both beneficial owners and company applicants is your full legal name, your date of birth, your current residential street address if you are a beneficial owner, or if you are a company applicant and you are in the business of representing companies in their formation, like a law firm or a CT or CSC, then you would disclose your business address rather than your residential address. And then you also have to submit an image of an unexpired US passport or an unexpired US issued, state issued, tribal issued driver's license. Or if you don't have those, you can submit another form of state issued or government issued ID that has both a government ID number and your photo on it. If you're not in the US and you have to be disclosed and you don't have any of those three, then you can use an unexpired non-US passport. But it has to be one of those four. You have to submit that as part of this filing. So FinCEN's not only going to have the ID number associated with that ID, they're also going to have your photo in the database. And the reason they are doing that is so that they can determine if there are, similar name hits, who they're actually dealing with. There are a lot of Bill Quicks running around out there, so they want to make sure it's the Bill Quick they're thinking of and not some other, rogue Bill Quick. So here's one of my favorite parts of the discussion, because this is where I actually I think this message is going to be helpful. This is what I call the cheat code of the Corporate Transparency Act. So if you're a gamer or you have gamers in your life, there's a term called a cheat code, and that's where you can get some nugget of information that can take your game to the next level if you can't finish the level of the game that you're on. So cheat code. So here's the cheat code. There's a thing called a FinCEN identifier number. And it's equivalent to like a known traveler number with TSA, if you've heard of that or gotten that. So if you take this same PII that you're going to have to disclose regardless, and you disclose that directly to FinCEN, then FinCEN will issue to you a FinCEN identifier number. And it's going to be a unique number, unique to you. You will have it the rest of your life. No one else can use that number. But it's great because you can use that number instead of providing your personal identifying information anytime you have to be disclosed in the Corporate Transparency Act database. So there are a number of benefits for this, both for you as an individual human being and also for the companies that you're associated with. So regardless of how your personal identifying information gets to FinCEN, if you have a change event, FinCEN, the filing with FinCEN that has your information has to be updated within 30 days of the change event to be accurate as of that point in time. And that's not 30 days after a company becomes aware of a change, that's 30 days after the change event. So if I've got a FinCEN identifier number, I can go to FinCEN's website and I can update my information when I change my name, I change my residence, my passport expires, I get a new passport. I can just go to FinCEN and just update my information. I have to do that within 30 days of the change event. If I instead have given to my personal identifying information to a business entity or multiple business entities, and those business entities turn around and have disclosed my personal information on their filing, then I have a legal obligation to notify those companies that my information has changed. Those companies have a completely independent obligation to update their filing within 30 days of that change event, even if they aren't aware of it and are never told about it. It has to happen within 30 days. So if you've reported PII on a company's BOIR filing, then you have an obligation and the company has an obligation to update that information. And if you're associated with a bunch of entities, not just one, you have to do that for all of those entities that have disclosed your information in the past. If instead you have a FinCEN identifier number, here's my FinCEN identifier number. They will put that information in their BOIR report instead of your PII. And that number never changes. So then the only time they're going to have to file an amendment is either up or down. You became a beneficial owner when you weren't before, or you no longer a beneficial owner and they have to take you off of their filing. So there's some real benefits both on the company side and on the individual side to getting a FinCEN identifier number. I have told people, I use strongly twice, strongly encourage any human being that's involved in this process to get a FinCEN identifier number. And I will be sad, dejected, and angry if I learn of anyone that has not done that. It's that important and that helpful. It is going to save you a whole bunch of pain and angst in the future if you get a FinCEN identifier number. I like to say, Future Bill is lazy, and I try to make life as easy as I can for Future Bill. This is one of the ways that you can make life easy for Future Bill or Future Jeff or whoever is on the Zoom. So that's in my spiel. It's pretty easy. The people that I have worked with, usually they report back like, oh yeah, that was a lot easier than I thought. It took me 10 minutes. You can get a FinCEN identifier number with a smartphone that has the ability to take a picture and your driver's license in 10 minutes a time. Very simple. Okay. So if you have determined you're a reporting company, you don't meet an exemption, then you have to make a filing. It's called the BOIR, Beneficial Ownership Information Report filing. We've talked about that. If you have a business entity that was in existence prior to January 1st of this year, and it was on existence at any point in time in 2024, you are obligated to make a BOIR filing with FinCEN. FinCEN, interestingly, on July 8th, came out with some frequently asked questions that reinforced this point. And this had been kind of an open issue of debate. I had been telling people all along, hey, the obligation to file is accrued. You just haven't hit the deadline yet. It's kind of like filing your tax return, your personal tax return for 2023. You have until April 15th to make that filing, but whether or not you have to make the filing is not contingent on anything other than you were around in 2023 earning income. So some people thought if you dissolve your entity in 2024 before you hit your deadline, then you just don't have to do anything. You're fine. FinCEN has come out and expressly said, no, if you're in existence at any point in time in 2024, you owe us a filing. And if you dissolve your entity, that's great. You still owe us a filing. That also applies for entities that were formed in 2024. They have 90 days from their creation date to make their initial filing, but their obligation to file accrued on the date that they formed that entity. So even if you dissolve the entity on day 89, you still have to make your BOIR filing. Starting January 1st of next year, you have the 30-day window to make your filing. If you've formed an entity or created an entity, you owe a BOIR filing, even if it was like the next day, you're like, oops, I didn't mean to do that. I shouldn't have done that. You have to make a filing. There is no filing requirement if you dissolve an entity. So if you've made your initial filing and then you dissolve the entity, you don't have to file anything with FinCEN. So it may be that you have these entities and you have a one-time filing, you're just done with it because you've dissolved the entity, but you will have to make that initial filing with FinCEN. So as we've talked about, there's also a 30-day window to make any filings of amendments to any filing that you've made with FinCEN before. So if you've made a FinCEN identifier filing or you've made a BOIR filing, you have 30 days from any change event that changes the factual accuracy of what you've previously disclosed. So if you said the company was on 3rd Street and we moved to 4th Street, that's going to generate an obligation to do an amendment. Or, Bill was our president, but then he, hit the lottery and now he's retired to Tahiti and he's no longer here. That's going to be an amendment because you have to take me off your list, regardless of what other things have happened. So you have 30 days from that change event, not from when you became aware of the change event. So you've got third parties out there. Bill likes to, be a serial, matrimonial person's been married 12 times and you're just waiting for number 13 to kick in. If I go to Vegas and do that, I don't tell you, it's still your filing obligation within 30 days after that event to be in compliance with the act. So if you have a filing that you've made and you determine that that filing was inaccurate at the time that the filing was made, you have 90 days from that filing date to correct the inaccuracy and get a free pass. If it's more than 90 days, you still have to correct that filing. You just don't get the free pass. But if it's within 90 days of the date that you did that filing, it's kind of like, oh, no harm, no foul. You corrected it. Thank you. We're moving on with life. So that's another deadline that you have to be cognizant of. So we kind of are backing into this concept, which, would be great if we had been able to talk about this first, but I think you have to have the context of what we're doing for this to even make sense. So now we're going to talk about, well, does the CTA apply to me? So the first step in the process for each business entity, and each business entity is going to have to independently, affirmatively go through this process and make this determination. So the first step is, well, am I a reporting company? Do I have an entity that was a U.S. entity that was created or a non-U.S. entity that was registered to do business in a jurisdiction in the U.S. through a filing with a Secretary of State's office or a tribal office if you're dealing with a Native American tribe, or an equivalent office. So, this also includes other U.S. jurisdictions, not just states, not just tribal land, District of Columbia, Puerto Rico, the Marshall Islands, any jurisdiction that is within the fold of the U.S. Umbrella, this equally applies to that jurisdiction. So if you've created an entity, we'll just call it like a corporation, an LLC. Those are easy to understand and think about. If you formed a corporation or LLC, you are going to be a reporting company if you were in existence as of January 1st, 2024 or later, or were created January 1st, 2024 or later. So you're in the soup. So if you're in the soup, there's one little ladle of exemptions that can take you back out of the soup. So it's kind of like the Glengarry Glen Ross movie where he's like, I've got the Glengarry Glen Ross files, but you can't have them. It's one of those situations. You could be accepted out. There are 23 exemptions. I'm going to talk a bit about those, but I would broadly categorize 20 of those as kind of this concept. Hey, we're already heavily regulated. We already have to publicly disclose a bunch of information about our owners and control people. So it would be silly and redundant for us to have to also file that again here. So those categories have been excluded. There's also one category for inactive entities. Spoiler alert, it's only applicable to you if your entity was in existence prior to January 1st, 2020. So currently inactive entities, if you were formed after that date, does not apply to you. That also, people aren't happy about that. There is an exception for subsidiaries. So if you have a subsidiary that is wholly owned by certain, but not necessarily all, of the other exempt categories, then you can share in the parent or parents, plural, exempt status as a subsidiary. Or there's an exception called the large operating company exemption. That's the one that most people conceivably could either achieve or not if you're just a normal business entity. So for the large operating company exemption, you have to meet 3 parts of a 3-part test. You have to meet all 3 parts. You have to have 21 or more full-time employees of that specific business entity, not of a group of affiliated parties. That specific business entity has to be issuing a W-2 for 21 or more full-time employees, not part-time, not leased employees, not independent contractors, has to be full-time employees, 21 or more. Second, you have to have more than $5 million, so $5,000,001 or more of gross sales or receipts solely from U.S. sources that you reported on a prior year's federal tax filing. So you have to both have over $5 million of revenue, and you have to have filed it on a prior year's tax filing. The third thing is that you have to have a U.S. commercial street address that you operate from. So it has to be a commercial street address, and your business entity either has to have a deed that says they own that property, or they have to have a commercial lease that says, hey, we're leasing that property. There's a little bit of ambiguity if you've got an affiliated group of entities and they're all kind of using the same street address. You probably are okay in that regard, but it would be better if you had a lease or a sublease that said, I have the right to use this. It can't be your home. It has to be a commercial street address. It can't be mailboxes, etc. It can't be a Regis or WeWorks office sharing situation. Those are all specifically precluded. It has to be a legitimate commercial street address you have a deed or a lease on. So if you can meet all 3 of those criteria, that specific business entity is going to be exempt. What I frequently see is, people have multiple business entities. They tend to have all their employees in one entity. And there's a lot of good reasons why they did that and are doing that. They have nothing to do with the Corporate Transparency Act. But what it does for the Corporate Transparency Act is it means only that entity is going to be able to count those employees. If you have a PEO where you've leased employees from another entity, that's not going to count toward your employee count. Also, it tends to be that the entity that has employees doesn't necessarily usually generate a lot of revenue. So the revenue is usually coming in from some other entity in the affiliated group. So it doesn't have the benefit of having the $5 million and the employees together in one entity. So if you have a subsidiary in your portfolio that meets the exemption, gets the large operating company exemption, that's great. If they have a wholly owned subsidiary, that subsidiary could also use the benefit, but it doesn't go upstream. So if you have a holding company or a parent company that owns that subsidiary that has the large operating company exemption, parent does not get to enjoy that exemption. But if the holding company level is the one that has the large operating company exemption, then any of its subsidiaries, if they're wholly owned, would be able to enjoy the subsidiary exemption, but it doesn't go the other way. So I've got a chart here, and obviously it's hard to read and probably isn't going to be useful if you don't have a copy of it. But I've got a chart that kind of walks through this exemption process. So the first step is, hey, are you doing business? Are you doing a business? Yeah. Are you a sole proprietor? Are you a estate planning trust or some kind of trust generated through a court order or under the common law? Or are you a general partnership? Then no, you don't have to deal with the Corporate Transparency Act. You are not within the definition of reporting company, so you just don't have to comply with the act. I'm going to say a little asterisk, though, because if you are one of those and you are associated with other business entities, you may get pulled into those other business entities' reporting obligations. It's just you don't have a BOIR filing obligation for that, sole proprietorship trust or general partnership. The second step is, okay, well, are you an entity that's formed at a Secretary of State's office, a corporation, business trust, cooperative, LLC, series LLC, or a series of a series LLC, decentralized autonomous organization, limited partnerships, etc.? Yes. Okay. Well, then we're going to go to the next step. Do you fit within an exemption category? And there are categories for, public reporting companies, registered broker dealers that deal in public securities, utilities, commodity exchanges, governmental and quasi-governmental bodies, banks, credit unions, money service businesses like Venmo. They're expressly excluded. If you're a CPA firm and you're registered under the Sarbanes-Oxley Act, then you're excluded. But if you're not registered under the Sarbanes-Oxley Act, too bad. You're with the doctors and the attorneys who don't like the fact that they have to report. If you have certain, but not all pooled investment vehicles, you may be able to be exempt. If you're a registered investment advisor, if you meet certain registration requirements, you can be exempt, but not all. Also, a big one is if you are a Internal Revenue Code Section 501C recognized federally tax exempt entity, then you are exempt from the filing obligations. But if you're not, and you're a nonprofit, you have to report. So there's a whole, group of homes association professionals that are up in arms, because if you're a homes association and you don't have a 501c designation, you have to report under this. I've got a little pond in my backyard that I share with some neighbors that's operated through a Kansas nonprofit company. We have to report that company. If you have a hunting property and you have some friends that all just pitched in some money and you each own a third of the LLC or corporation that owns that property, that has to be reported. If you've got any other kind of, crazy thing where it's, oh, well, I think it'd be fun to have an LLC or a corporation so I can say I own a business. Well, you have to report under the Corporate Transparency Act. So there's no outs for simple non-business, et cetera. If you meet the criteria, you have to report. And then we talked about the last step here, which is the large operating company exemption. If none of those work in your favor, then boom, you're a reporting company. You have to report a BOIR. So we talked about the large operating company exemption. We talked about the subsidiary exemption. We talked about the inactive entity exemption. There's a bunch of hoops you have to jump through, but if you were around prior to January 1st, 2020, which is 1 year before the Corporate Transparency Act was enacted, and you meet these other criteria, then you don't have to report. But if you are an administratively dissolved business entity, you have to report, which is going to take a lot of people and is taking a lot of people by surprise. If your entity has been administratively dissolved, you just stopped paying your franchise tax, or you stopped doing your annual reports with the state, and the state said, hey, we're pulling your charter, you can't do that. Because you have the ability to march into the Secretary of State's office at any time, plop down a certain amount of cash, and reinstate that entity as though nothing happened, FinCEN says that entity is doing business or has ability to do business, they have to file a beneficial ownership information report. So that, along with the dissolved entities, taking a lot of people by surprise, you have to do that to comply.
Bill, we have a few questions in the chat, if you don't mind. One was the how do you spell the identifier, and that was the FIN and then CEN, all one word, FinCEN, right?
Yes. So let me join that with this. So you can go on to FinCEN's website. So if you get into your Google or whatever your browser search mechanism is, if you type capital F, small I, small n, capital C, capital E, capital N, Financial Crimes Enforcement Network. If you do FinCEN space BOI, beneficial ownership information. So FinCEN BOI, type that in your browser, it will pull up FinCEN's webpage that's associated with the Corporate Transparency Act specifically.
Okay, I was able to find it at finson.gov/BOI. Is that
Yep.
sound about
Yep.
right?
That's it. And then, so if you look in the upper right corner of that page, there are some options. One is file a report, and then right below that is file for a FinCEN identifier number. So
Another
if you go to the second one down, you can click on that and it will take you to their site where you can file for a FinCEN identifier number. You are going to need a .gov ID. I think you just have to put in your email address and your name to get that. You will have to get that. That's part of the process. They'll take you through. Once you have that, you can get into their filing system and you can type in your information, get a FinCEN identifier. It will spit it out and give you a number
I think that
while you're sitting.
covers two questions actually, so I
Yeah.
think we're good. And then we also had would a nonprofit educational foundation, for instance, be exempt?
If it is recognized under 501c of the Internal Revenue Code. If not, then no.
It doesn't matter if it's like C3, C6.
Nope. Any C, any C.
Okay. I believe that's all we had at this point. So please go
Okay.
ahead.
So while I'm giving out web addresses, if you go in your browser and you type in Polsinelli, which is, I'll spell that for you, Polsinelli. If you type in Polsinelli and then space Corporate Transparency Act, and you probably just put corporate trans P or something, it'll get there. That will take you to our law firm's webpage that I curate. And has a wealth of information about the Corporate Transparency Act, more information than you could believe or want. But you can get on there and it will get you a lot of information that's helpful. Again, if you go to the right side and go down the page, I think there's a button there's a button you can click on, put in your email, and then you can be on our distribution list. So every time FinCEN comes out with a new frequently asked question or something new happens with the Corporate Transparency Act, we push out e-blasts and you will be included on that list. You can get updates on that information as well. And then obviously you can
chat right now. So, and I'll post it with all the video and all that good stuff. Link to that.
Yep. And you're welcome to get a hold of me. My information's on the website. It's also, well, I'll just give it to you. It's WQuick, WQUICK at polsinelli.com, POLSINELLI.com. So you're welcome to reach out to me. I'm also on LinkedIn, William Quick, all one word. And I post quite a bit on LinkedIn as well about the Corporate Transparency Act updates as they happen. So that's also a useful resource. So because nothing's simple with the Corporate Transparency Act, I'm going to alert you to this. Missouri is not a community property state, but if you have a business entity and you have investors in that who are in a community property state like Arizona or Texas or California, if you have an owner of the business that's a beneficial owner because of their ownership, and that person is married and they live in a community property state, then not only do you have to disclose that person's information in the BOIR report, you also have to report their spouse's information because their spouse has a joint right to ownership in the entirety of the primary person you're dealing with. So if you've got someone who runs a business, owns a business, and they're married and living in a community property state, even though the spouse has nothing to do with the business, you have to also disclose them because of the community property relationship. I don't think we have time, but if you are have a trust that's a beneficial owner, the trustee of that trust is going to be deemed to be the beneficial owner for the purposes of the trust ownership. So if you have a trust that has 25% or more ownership, the trustee of the trust has to be disclosed. If the beneficiaries of the trust have any rights to appoint or remove the trustee, change the trust document, direct the trustee to buy or sell assets or make disbursements from the trust, then the beneficiaries of the trust also have to be factored into the beneficial ownership calculation to determine if they have to be disclosed. If you're the grantor of the trust and you have the ability to unwind the trust or appoint or remove the trustee, you are going to be attributed with ownership of that trust. If you own economic interest in a business entity through different means, so say you have multiple trusts that you are a beneficiary of or that you're a trustee of, you have to aggregate all of those interests in determining whether you've met the 25% or more threshold. So if you have a situation where you've got 5 trusts that each own 20% of the company, you're like, great, no one owns 25% or more, so we don't have to disclose anyone the ownership. But if you have the same trustee for all of those trusts, then that trustee's ownership is going to be aggregated 100%, and they're going to have to disclose that as a beneficial owner. So, if you have any kind of nuance or complexity to your ownership or control structure with your business, this is going to be a more complicated, nuanced analysis to get this right. So, question everybody wants, hey, am I going to jail? So there are penalties associated with not complying with the act and with improperly complying with the act. Those penalties are $10,000 per day up to $500 per day up to $10,000 per incident for violations of the act. So that could be a violation by the company if it has not made an amendment that it's supposed to, but it could also be penalties for human beings that aren't the company. So until the company files its initial beneficial ownership information report, anyone who has substantial control, or at least all of the senior officers of that entity, are individually and severally liable for that filing to occur. So if a filing doesn't occur, those human beings are each on the hook for that violation. And they each are on the hook for $500 per day up to $10,000 per incident. So if you do the math, that means if it goes more than 20 days without being corrected, you're up to the maximum. And oh, by the way, again, nothing simple here. It's not $500 per day or $10,000 per incident. It's as of January 1st, 2021 dollars. So there's an escalator that applies for, for lack of a better term, cost of living increases. So as of January of this year and until January of next year, that number is actually $591 per day, or $11,820 per incident is the fine amount. And that will change each year going forward. Presumably it's going to keep going up. Could go down, but it's probably going to go up. The other aspect is each violation of the act can garner criminal penalty of up to 2 years in federal prison. So shocking. The good news is FinCEN has orally, but not in writing, said, hey, we're not in the gotcha game. If you're doing your best and you're complying, we're not going to come after you with a hammer for, simple violations, as long as you're making a good faith effort. But if you're not making a good faith effort, or you're oligarch or kleptocrat or terrorist financing group or whoever else, oh yeah, we're coming after you, and you're going to have that 2-year penalty. What I think is going to happen is, as I talked about, the IRS is going to use this resource as part of their enforcement for their audits. This is going to be I don't anticipate there being a lot of people being charged with violations of the Corporate Transparency Act as the reason that they're in hot water. I think what's going to happen is this is going to be dogpiled onto whatever other agency's prosecution that they're bringing, and it's just going to be another factor that adds more heft and weight to their push to make you settle whatever they want you to settle, because now you've got another 2 years of federal prison time for each violation that they can bring to bear. So we talked a little bit at the beginning, and I want to be mindful of people's time, but I'll keep going to the end of the slideshow if that's all right with you, Jeff, or we can cut it off. I know we're at 102 already.
Well, that's fine with me, and then I can always send if anybody has to drop off. I know we've had like one or two, but if they have to drop off, then I'll send this video out and they can watch the rest.
Okay. Well, that sounds good. So there was a federal court ruling on March 1st of this year in the Northern District of Alabama, where the trial judge said, "Hey, I'm not even going to listen to this case. I'm going to rule on summary judgment," which means before they've even, went in and argued their case. This is just unconstitutional, and we don't even have to get to the merits of the case. Congress has exceeded the powers that Congress has. Treasury has exceeded the powers that Treasury has under the Constitution. Unconstitutional. Plaintiffs prevail. Oh, by the way, only the plaintiffs in this case prevail. This ruling doesn't apply to anyone else in the U.S. Only the plaintiffs in this case. So you don't have to comply. FinCEN almost immediately, within a week, appealed that to the 11th Circuit, which was no surprise. And they came out and said, "Hey, we're going to honor this ruling for as long as it's in force. So it's throwing a little shade on the trial judge there. We'll honor this as long as it's in force. As to the plaintiffs in this case, which is the NSBU, which is a small business association, and there's some ambiguity as to whether that applied to the members of the NSBU or not, or just to the NSBU itself." And FinCEN said, "Hey, we're going to voluntarily not enforce the Corporate Transparency Act to the members of that organization as of the date of the ruling." So if you were a member of the NSBU on March 1st, then it's not saying we're not going to enforce it. They just said we're not going to enforce it right now. Everyone else in the world and universe has to comply with the act. And we're not going to, if you let your membership dues lapse and you weren't a member on March 1st, or if you ran out and cut them a check on March 2nd because you're like, darn, I want to get in on this, doesn't apply to you either. So it's only the members as of March 1st, and it's only the members. So if the member is a business entity, it's only that specific business entity. It's not other business entities that are, in a common portfolio. It's not the human beings who were owners of that business entity or controlled that business entity, or vice versa. If it was a human that was the member, the business entity doesn't enjoy that exclusion. So it's very limited. It's not that you're going to even have that great of an exclusion, because the people that are excluded are likely going to get pulled in to the compliance obligations because they're going to have some other nexus with the Corporate Transparency Act that isn't solely isolated with that membership. So, most of the media in the world is like, "Oh, great, unconstitutional, end of thought process, end of hearing." It's like, I don't want to hear anymore. It's unconstitutional. It's not. It's, as a practical measure, it's not unconstitutional. So that ruling is winding its way through the 11th Circuit right now. Both FinCEN and Treasury, U.S. Treasury on the one side and the NSBU on the other side, have filed their pleadings in that matter. They've filed responsive pleadings to each other's pleadings. There have been, I think, at least 25 amici briefs filed by, friends of the court is what amicus brief means, where it's just third parties that want to make sure that all the issues associated with this are vetted. So there have been a huge amount of those interjections made, and we're just waiting at this point to see how this proceeds and if there's any change or not. I will say with almost complete certainty that whoever loses that 11th Circuit, case is going to appeal either to the 11th Circuit en banc, which means all of the judges on the 11th Circuit. So right now it's getting heard by 3 judges, I believe. So it's either going to get appealed to the whole 11th Circuit panel of judges, and or it's also going to get appealed to the U.S. Supreme Court. No one's going to like, oh, whatever, I lost, good on you. We'll honor this. It's not going to happen. It's going to keep going. If the 11th Circuit says, no, judge, you got this wrong, that's not the end of it either. The case just goes back to the trial judge, and then they have to have the trial. They never had the trial in the first case. So this is not getting resolved anytime soon. It's not going to get resolved before January 1st, 2025, when the vast majority of those 32 million business entities I talked about earlier are going to have to file. There's not going to be any legislative fix. That there's not going to be any legislation that passes both the House and the Senate and gets signed by the president before January 1st. That's not going to happen. FinCEN has made no indication that they're going to slow down at all. As a matter of fact, if there's any indication, they've put the pedal to the metal and it's speeding up. So this is happening. Get on board, get your filing done. It's not as arduous or painful as people assume it will be. I would say just get in and get it done. I would also not wait till the end of the year to try and deal with this. I would just deal with it now in Q3 and be done with it. There could be other complicating factors if you wait too long, because there's going to be a huge tsunami of compliance trying to happen. And if you're needing help from professional advisors or third-party vendors, it's going to be better to do it now while you can get their attention, rather than later when everyone's running around with their hair on fire. So with that, I will call this to an end. I hope everyone found this informative. I know no one is enjoying this topic. Hopefully you enjoyed the presentation style with the topic, but no one likes this topic. I feel like the messenger back in the old medieval days, and I'm always like looking around to make sure that no one's sneaking up behind me. But hopefully this is a useful message. As I said, I'm happy to discuss this with anyone that may want to discuss it further. With that, thank you, Jeff.
Thank you, Bill, and we'll get this posted up with your contact information. If anybody has any additional questions and they want to speak to you, more of a one-on-one, I assume that's something that's okay.
Yes, happy to do it.
Perfect. Thank you so much again, and thank you all for joining us on this Zoom Lunch and Learn. It has been very informative, and yeah, it seems like one of those things that people will have to reluctantly to understand, even if they don't necessarily want it or want to. So I appreciate your time today, sir.
All right. Well, take care. I hope you all have a great afternoon.
You as well. Have a good day, everybody.